How do management fees affect your returns on investing in mutual funds? A number of different costs associated with investing on mutual funds or ETFs are passed on to investors. Portfolio management fees, trade execution expenses, marketing and distribution costs, to name some of them. Using a dataset that contains the net expense ratio and the Morningstar rating on 25,308 mutual funds of all investment categories, stocks, bonds, etc., we can investigate whether there's a relationship between the two and if this relationship also regards the fund's returns. There are two types of fees an investor is charged when investing in a mutual fund. Expenses directly borne by the investor, usually when investing or divesting, and expenses indirectly borne by the investor, encompassing management, transaction, custody, and distribution costs. These are costs the fund incurs into because they are subtracted from the fund assets. The former are referred to as upfront or redemption loads and are deducted from the amount being invested or being divested. The latter are ongoing fees borne by the fund and thus reduce the returns the fund will pay its investors. Then what is the net expense ratio shown on Morningstar's website? It belongs to the category of costs indirectly borne by the investor and is the net percentage of fund assets paid for operating and management fees. It doesn't reflect the costs an investor bears as upfront or redemption loads. What is a fund's Morningstar rating? The Morningstar rating is based on a straightforward and widely applied logic in assessing a mutual fund's returns. A fund is ranked according to a measure of its return-to-risk ratio, adjusted by the fund's upfront or redemption loads, called Morningstar Risk-Adjusted Return, and then is assigned to one of 5 rating classes, with 5 stars being the best and 1 star being the worst. So the Morningstar rating is affected by both the fees directly and indirectly borne by the investor, and it can be considered a proxy of a fund's relative returns in relation to its category. It's also adjusted by risk and upfront or redemption loads. Is there a relationship between a fund's returns and its net expense ratio? Can we see it? The answer is yes to both questions. What we have here is the net expense ratio, that is the net percentage charged on a fund's assets, and the Morningstar rating, which we can consider a proxy for a fund's risk-adjusted relative returns. An investor's performance is negatively affected by a fund's fees, and the Morningstar rating factors in these costs. So, does the net expense ratio account for a fund's performances? Can we investigate this relationship using the Morningstar rating? Yes, we can. If we want to study this relationship, one possible way is to visualize the data by plotting them in one or a few charts. And since we have a large dataset with over 25,000 funds, we'll need some hacks. We can try and investigate this relationship by plotting the distribution of these funds' net expense ratios, and by displaying it using different colors based on the fund's Morningstar rating. We can see that the higher the net expense ratio, the lower, with darker blue and teal colors, the Morningstar rating. I've stacked the densities in this distribution plot, and by using this type of chart, we don't see how many funds there are in each rating class. We can only see that there seems to be a negative relationship between the rating and the net expense ratio. Indeed, the distribution in the net expense ratio is skewed to the right, the lower the Morningstar rating. The darker colors represent the lower ratings, 1, 2, and perhaps even 3, and these tend to be stacked towards the right of this chart. A scatter plot helps us investigate the relationship between fees and the fund's performances, since the Morningstar rating represents a risk-adjusted return. This chart shows the relationship between a fund's Morningstar rating and its net expense ratio, using a log scale so that proportions are held constant. A small amount of variation, or jitter, has been added to the location of each point, and besides, these points have been rendered with a little transparency to help overcome overplotting. Again, because we have thousands of points overlapping with one another. The great majority of funds is ranked with 2, 3, and 4 stars, and this depends on the methodology of Morningstar to allocate from top to bottom 5 stars to the best 10% funds in terms of Morningstar risk-adjusted return, 4 stars to the next 22.5%, 3 stars to the next 35%, 2 stars to the next 22.5%, and 1 star to the bottom 10%. We can see again that there's a negative slope in the relationship between a fund's net expense ratio and its Morningstar rating, regardless of a fund's investment category. What we see here is that a fund's net expense is a burden on its Morningstar rating, and thus on its returns in relation to the fund's category. Finally, we can recap this analysis by using a box and whisker plot to summarize this relationship between fees and returns. If you're not familiar with it, a box and whisker plot compactly shows the distribution of a continuous variable displaying 5 different statistics. The median, the first and third quartile, and the min and the max on the 2 whiskers, along with all the outliers as points extending away from the min and the max. We can argue that the net expense ratio must affect a fund's Morningstar rating by decreasing its returns. By and large, the net expense ratio summarizes the net percentage paid by investors from the assets under management, regardless of how successful the managers have been. One would claim that higher management and operating fees are explained by superior outcomes in terms of performances or risks, but that doesn't seem to be the case. Why does regulation stress so much transparency on fees? Because of asymmetric information between the asset management industry and its private clients. While active managers claim to either enhance performances or reduce risks with their unparalleled security selection or market timing skills, even via fancy quantitative algorithms, economic research has shed light on how little investors pay attention to the fees they only indirectly are charged, for they are perceived as less meaningful because of their hidden nature. As is consistent with the extensive research accumulated on the topic over the decades, we can argue that by holding everything else equal, keeping careful attention to the net expense ratio associated with investing on a mutual fund is the first way to enhance an investor's performance. By and large, investing in a low-fee mutual fund can be considered to be the first way to maximize returns.